All right. 63% of working aged Americans just put groceries on a credit card, and the missed payment rate on those cards, they just jumped again. That is not a budgeting problem. That is the household version of a margin call. And the nation's three biggest banks confirm it with their own numbers that just came out this week. Check this out. This may blow your mind.
You are standing in the checkout line, and the total on the screen is $30 higher than the same cart cost you a year ago. The person ahead of you just quietly handed something back to the cashier. A pack of chicken maybe, or the name brand cereal. And you tell yourself, it is just you. Just this week, just this one store. It is not just you. Here is the number that explains what you felt. 63.2%. That is how many working age Americans put groceries on a credit card at some point in the past year. From a study the Urban Institute, a nonpartisan research group, published on July 8th. And here is why the timing matters. Yesterday morning, the biggest banks in the country, JP Morgan, Citigroup, and Wells Fargo, all reported how their customers are actually doing at paying those cards back. Stay with me, because when you put the study and the bank results side by side, you get a picture that is more important and honestly stranger than the panic headlines. Now, let me be straight with you right away, because the honest version of this is the one worth your time. That 63% is not 63% of America unable to afford food. More than half of that group, about 35% of all working age adults, put groceries on a card and paid the bill off in full every single month. That is not distress. That is people chasing airline miles and cash back, and there is nothing wrong with it. The part that should give your attention is the slice sitting underneath, because more than 1 in 4 working age adults used a credit card for groceries and then could not clear it. They carried the balance or then missed the minimum payment entirely. And that struggling group is growing. Grocery prices are up 32% over the last 5 years, and paychecks have not kept that pace. The share of people who did not always make even the minimum payment on their grocery cards rose from just over 7% in 2023 to nearly 9% last year. Among middle-income families, households earning roughly $65,000 to $130,000 a year, the share who could not make the minimum jumped from 9% to more than 12%. This is not just the very poor. This is the middle of the country. And then there is the newest wrinkle. Nearly 1 in 10 adults used buy now, pay later, those apps that split a purchase into 4 supposedly interest-free installments just to buy groceries. Of the people doing that with their food, more than a third missed a payment. Read that again. A third of the people financing their groceries in 4 installments could not make the installments. And it is not only cards and apps. About 1 in 5 working age adults dipped into long-term savings, money meant for an emergency, just to buy food. 1 in 20 pulled cash from a payday loan to do it. When the emergency fund becomes the grocery fund, the safety net is already gone. Here is the frame I want you to hold for the rest of this. When you put food, something you consume and it is gone in a week, onto debt that compounds, you have done something to your household that looks a lot like a margin call. On Wall Street, a margin call is when the thing you borrowed against loses value and the broker demands cash you do not have right now, or they sell you out. The kitchen version is quieter. The grocery bill outruns the paycheck, the card covers the gap, and now the gap itself is charging you rent. And rent is the right word because of the interest rate. The average rate on credit cards that are actually carrying a balance just hit 22%, near a record according to the Federal Reserve. So picture a household putting $150 of groceries on a card every week and never quite clearing it. For every week's worth of groceries they carry for a year, they hand the bank roughly an extra $33 in interest.
Hey, real quick, just throwing this out there. If you're in debt and you're sick and tired of it and you want to break that chain, I put together an entire program on how to dominate debt. Links down below. Check it out. I think it will be a game changer for you. Now let's get back to the video.
You are paying a 22% surcharge on food you already ate. The chicken is long gone. The interest is still on the statement. And it is not happening in a vacuum, because a gallon of gas is averaging around $4.50 right now, up from a little over $3 a year ago. So the same paycheck is getting squeezed at the pump and the register at the same time. There is a sequence to how this happens, and you have probably watched it in your own life without naming it. First, people ration, they skip items, they buy less, then they substitute down, name brand to store brand, fresh to frozen, then they reach for pay later, then they revolve the card, meaning they carry the balance instead of paying it off. And then, for some, comes the missed minimum. Rationing comes before revolving, and revolving comes before default. When you saw the person ahead of you hand back the chicken, you were watching the first rung of that ladder in real time. Now here is where I have to be honest with you again, because this is where a lot of channels would lie to make you scared. You would expect all of this to show up as an explosion in credit card debt and a wave of losses at the banks. It is not, at least not yet, and the reason is genuinely interesting. Total credit card balances actually fell last quarter by $25 billion, down to $1.25 trillion, the New York Federal Reserve reported. Some of that is just the normal January drop after holiday spending. And when those big banks reported yesterday, they did not flash red. JP Morgan's card losses held right around the 3.5% it had already predicted for the year. It actually set aside less money for future card losses than it did the quarter before. And its executives called the American consumer resilient. So sit with the contradiction, because it is the whole point. The banks are calm. The total debt number is flat to falling. And yet a rising share of families cannot make the minimum payment on their groceries, and more than half of card-carrying Americans, 53% in one survey out the same week, say they are carrying a balance specifically to cover essentials. As one analyst put it, higher balances there are less a sign of confidence than a sign that wages and savings cannot keep up with the basics. Both things are true at once. What it tells you is that the strain shows up first in behavior, down at the kitchen table, long before it shows up in a bank's quarterly loss report. The banks are a rear-view mirror. You, standing in that checkout line, are the windshield. Economists even have a name for the split, a K-shaped economy, where the top half stays steady while the bottom half quietly buckles and the averages hide it. This is not the first time the checkout lane saw it first. Go back to 2007, right before the last crash. 46% of American families were carrying a credit card balance, and the average family that carried one owed about $7,300. For years, they had been paying those cards down fast because their homes were rising in value and they could pull cash out to cover the expensive card debt. Then the housing market cracked, that home equity dried up, and a Federal Reserve governor named Elizabeth Duke later described exactly what happened next. Starting in 2007, households began paying off their card debt at a dramatically slower pace. And that slowdown ran straight into 2008 and 2009 as the economy came apart. The card was the last thing keeping the lights on, right up until it wasn't. I am not telling you 2008 is about to happen again on a schedule. It is a rhyme, not a photocopy. But watch the one move that turned that slowdown into a crunch. When banks get nervous, they do not send you a warning letter. They quietly cut your credit limit. And when they cut the limit on a household that is already using the card to eat, that household has nowhere left to go. The next real signal lands in October, when the banks report the third quarter and we find out whether those charge-offs, the balances they finally give up trying to collect, start climbing. You already know which direction the pressure is pointing, so here is what to actually do with this week, not someday. The reason to move now is that every month you carry it, that 22% is compounding against you. Start by listing every debt you have by its interest rate, highest first, and your credit cards are almost certainly at the top. Then get your groceries off the card. Move food spending to cash or a debit card so you stop stacking new balance on top of the old. Call your card issuer and ask for a lower rate. And ask about hardship programs before you fall behind, because they help far more willingly before a missed payment than after one. Put everything you can at that 22% card before any lower rate debt. And if it is at all possible, build 1 week of grocery money in cash. because that single buffer is the thing that breaks the revolving cycle, because that is the truth underneath the number. The 63% did not choose this. The margin call did not come from a broker in a suit on a trading floor. It came to the kitchen, one grocery run at a time. You felt it at the checkout counter before any bank put it in a report, and that instinct was right. The grocery line is the credit line now. Economic Ninja is out.